What's going on, guys? In this video, I'm going to be talking about Tesla and Tesla's options. I'm going to be giving you a number of different strategies, from the poor man's covered call to leaps to covered calls to spreads. You guys are in store for so much in this video that's going to be very informational, and let's just get to the point right now and not waste any time. All right, so first of all, I'm going to look at the chart on Tesla because, to be honest with you, since the stock has skyrocketed a lot, it is difficult to say what it's going to do. So I'm just going to tell you the different strategies that I think are interesting right now, and you pick which one is best for you based on your view, because I don't want to necessarily tell you what to do. I just want you to think for yourself. All right, so first things first, let's pull up Tesla's options. I'm going to pull up Tesla. I'm going to go to the option chain. So let's go to trade Tesla options. Now, the first thing that I would do is, given the meteoric rise, or however we say that word, right? The stock is up a lot. I think you can make a case and say that Tesla is likely to continue rising due to high momentum, due to investor sentiment, and the stock has pulled back. So it's likely to potentially go up or down a lot, either direction, which is why I think a straddle is also very good. Let me teach you step-by-step strategy. All right. So the first one is going to be the bull call spread. The bull call spread is going to look like this. You're going to pick an expiration date that is going to be, into the future. Let's just say 23 days. All right. Nothing crazy. 3 weeks out. All right. Now I would pick the first out of the money option. It doesn't necessarily have to be. I'll tell you the difference. All right. But first of all, 255, the delta here is 0.55. What you can do is you can simply buy at 255 and sell at 260. This right here would be a bull call spread, giving you $5 of upside. You're risking about $230 to make $270. So you can double your money. Now, if you want to make a little bit more of a long shot bet, let's say that you think Tesla's going to go up a little bit more, then you can actually go more out of the money. So you can go for, let's say, 280. You can buy at 280 and then you can sell a 285. So remember, you're always going to be buying the closer to the money leg and selling the farther from the money leg. So it's always going to be a debit. This is going to cost you money. That's why it's called a call debit spread or a bull call spread. However, here you will see that because you are making more of a long shot, and the market and other investors, they understand this, right? I mean, they know that these options are farther out of the money. There's a less chance of this happening. Like if I expand this, the delta is 0.34. So the delta is lower, the option is more out of the money, and you are taking on kind of a bigger Hail Mary, right? This is like less certain. Like if we're going to make a football analogy, instead of a pass, this is more of like a long distance throw, right? Someone is like 30 yards away or whatever, right? So you get what I'm saying, right? Higher risk. Higher risk, well, guess what? Higher reward. So the max loss here is less, 123. Your maximum profit is 377. So now you should be able to conceptualize in your head that the farther out of the money you go, the higher the risk. So is that better or worse? Well, the risk to return is better, but the chances of this happening is lower. So it's actually about the same. All right, so let me get rid of this buy and sell. Let me actually show you something really interesting. So let's go for it. All right, so in the money. You can buy 245 bull call spread and then sell the 250. So this is going to have, you see how you're risking 280 only to make 220. You might say, oh, well, this is lower. This is worse risk to return. Well, this is actually in the money. So even if Tesla goes sideways now and it goes nowhere, you're actually getting like a 80% return or something really, really big. So this is another interesting strategy right here that you can use on Tesla. This can help you basically almost double your money based on your view. All right, so that is the bull call spread. A bull call spread, again, it benefits if a stock goes up, and it could actually benefit if a stock goes sideways. As you just saw with the bull call spread, you can manipulate it in many different ways depending on the strike that you pick. All right, so that is the first one. Now, the next thing that you can do is you can just jump into Tesla with a leap option. All right, so what is a leap? A leap is a long-term option. All right, it's long-term in nature, around 12 months. So I can buy something that is roughly 12 months away or even more. That's what a leap is. So here's the September 19, 2025, and this would be very expensive. I'm going to show you how to make a leap option less expensive, but first of all, let's start off with just the leap option. All right, so you can buy an out of the money leap. So we can go for, let's say, 300. All right, this would be a pretty out of the money leap, but if Tesla goes to 400, you'll double your money. If Tesla goes to 500, well, you'll basically triple your money. So you will get a pretty crazy return here, depending on if Tesla goes up and how much it goes up. Here, the delta is pretty high, so the market is actually expecting Tesla to rise in the long term. You see here how your upside is actually unlimited. In the case of a leap option, you are basically buying a call option. A leap option is a call option. We just call it a leap because it's very long term in nature. This option right here is going to cost $5,000. So that is that. Now let me show you a little bit closer to the money leap option, all right, or actually in the money. So let's go for, let's say 230. Here the delta is very high, it's 0.71. That's a good thing if you're bullish, because basically for every dollar that the stock moves up, the option is going to move up in this scenario by 71 cents. So you're going to get a very good upside exposure. You are going to make good money if the stock goes up. So this is a good thing, all right? So the 230 call right here, you can see how it's going for 7,900. This is going for 7,900, right? Again, unlimited upside. Everything is basically the same, except that you have a higher delta. There's a higher chance of Tesla being 230. I mean, it's already at 252. So that's why this option costs more. It's going to cost more because it's in the money. It's likely to stay in the money, and it has more upside exposure. So it's going to cost more. But actually, it doesn't cost that much more. So for me, I showed you first of all the example of an out of the money call at 300, but I would much prefer the 230. I would greatly much prefer the 230. Now, how do you make this cheaper? Well, actually the good news is you can actually sell call options against a leap option, and this would be called the poor man's covered call strategy. It's called the poor man's covered call strategy because you don't have to buy 100 shares. You can basically be a poor man and use the long call option just like you can use 100 shares. So you don't need 100 shares. That's what makes this strategy amazing. Fantastic. So let's go for a 90 days to expiration here. So this is going to be 3 months out. And let's just say we think Tesla's going to go up, but we don't think it's going to go up that much. It's going to go to 285, let's say. So that's reasonable to bet that it won't go too much higher than 10% up. So here's a crazy and cool thing about the poor man's covered call. Basically, you can start selling covered calls, and now you will still make upside. You will still make money as the stock goes up. You will literally benefit as the stock goes higher. But at 285, this is an interesting inflection point here. You will start to lose a little bit of money, lose a little bit of profits, not lose money, but lose some of the gains, okay? That's because this 285 covered call will act against you. But the good news is it's expiring in 90 days. So even if it goes up, you can still close out this position for a gain, right? Now, instead of putting up 7,900, you're only putting up 5,800, which is the same thing that I just showed you with the 300 call. And the crazy thing is this is only going out 3 months. So you can do the strategy 4 times. For example, collect 2,000, 2,000, 2,000, 4 times, that's $8,000. You can completely pay for this long call option. You can make it free, all right? So, I mean, that's in theory, right? That's if Tesla continues to go up and behaves properly. Now, obviously, if it goes down, you are going to lose money, just like everyone in the world is going to lose money on a regular stock. So this is a bullish strategy. You can see how you will lose money if the stock goes down. So that is a given. And you will make money if the stock goes up. And even if it goes above 285, you simply close out the position as a whole, okay? Close out the position as a whole. Close out both contracts. Close out the 230 and the 285 to make life simple. But if you want to get a little bit more complicated, you can roll up the $285 call option. I will add the rolling videos for you guys in the description, but you can also just type in Invest with Henry rolling, and then you will see exactly how to roll up a position. Now, I can also show you rolling. If you just want me to comment down below, I can make a follow-up video to this on rolling a poor man's covered call. So anyways, I've got your back, but basically I typically close out the position as a whole, or I roll it higher. Now, the other strategy that I want to show you is going to be a put credit spread. Now, this is something that I like to use all the time in my community on Discord. I am using put credit spreads. However, I will say that I don't really like put credit spreads on Tesla right now. And that's because Tesla has gone up a lot, 60% in the past 3 months. And if it pulls down, it will pull down heavy. So I don't think it makes that much sense to use a selling strategy like a put credit spread. But I want to show you a put credit spread quickly. And then I want to show you what selling a put option will look like on Tesla and which strike price I would pick, because one is good and one kind of isn't that good at the moment. So let's go for, in the middle of August here. And I'm going to basically just set up a quick put credit spread. And this could work, by the way. If you go very out of the money, 220, I mean, this is not bad. I mean, it's not too bad. If you sell at 220 and then you buy at 215, all right, so selling and buying here, you can see how, you'll collect pretty good income. $100 on 400, you'll get a 25% return. And basically, you hope that Tesla doesn't fall below 220. So that could work. Now, also what I would say is you can simply just, sell the 220 and leave it as is. Here, if you sell the 220, you can start running the wheel strategy by basically, you sold this option, you get $500, and now you're ready to take ownership of Tesla if it pulls back down to 220. I would say this is really good because selling a put option goes hand in hand with the wheel strategy, you sell a put option to get in and then you do a covered call to get out, I would absolutely favor this strategy completely. So I would say this is a fantastic strategy. Now, the last strategy I'll show you is going to be like a lottery strategy. This is where you can multiply your money many times, and it's a little bit riskier, and I don't personally do it all the time, but I just want to show it to you. All right. So what you can do is you can sell a put option, and let's say that we're going to use the 250, and then you can basically buy a put option that's, let's go up by 20. Okay, let's go up by 20 to 270. And then we're also going to use the 250 as a reference point. We went up to 270, we went up by 20, but now we're going to go back to 250 and use this as a reference to go down by 20. We're going to pick up the 230 here. Okay, now this is going to look a little bit weird. All right, so we bought, and sold. Now what you want to do is you want to go to custom ratio right here. All right, and you want to create an even amount of sells for each buy. I want there to be 2 sells and then buy and buy. All right, here you will see that this is a very interesting strategy where you will basically benefit if Tesla doesn't do anything. So maybe you're one of these investors out here that says, hey, Tesla gone up a lot and now I don't see anything happening with Tesla. I think it's going to move sideways. Well, here we go. You can basically risk $360 to make $1,600. All right, so this is where you can basically more than 4x your money in a month. So if you were to do this in a year, and let's just hypothetically say you were to win this type of trade 12 months out of the year, well, you can already imagine that you're going to get like a 20x return in a year. All right, so you can 20x your money with a strategy, but it's a very difficult strategy to manage because there's 4 legs, there's 4 bid-ask spreads, but this could be a really good strategy to mix in if you are very neutral on a stock. You don't have to use Tesla, you can just pick any neutral stock. But I will say I do not personally teach this strategy in my coaching, my Monday and Wednesday coaching calls, or any of the trades I'm making. I don't personally run this strategy due to the heavy amount of management that this strategy takes. So I personally wouldn't use it, but I want you to have a good understanding of more strategies on this video. I know I've seen your guys' comments. You've been asking me to make videos that are closer to my old style. So we'll see how this video does. Hope that you guys really enjoy it, and make sure that you watch my video on rolling, and also make sure that you watch my small account playlist, because there I talk about spreads. I talk about iron condors. I have an ultimate guide to trading spreads, which I'll actually just leave up on this video right now so you can watch that. I think it's one of the most important skills that you can have, which is managing a small portfolio. Grow the small money, then you can grow a medium portfolio, and then you can obviously eventually grow your account size to a large portfolio. So catch you guys in the next video. Make sure to keep watching.